Hi, welcome to a video on the accounting for sales returns. Customers have the right to return merchandise. The term sales returns appropriately refers to these returns. The seller must reduce revenue for all returns of current period sales. Indeed, some of these returns will happen in the next fiscal year or the next period. So the company in that case will have to estimate the amount of current year sales that will be returned early next year. An end of period adjusting journal entry will be used to adjust net accounts receivable. A percentage of sales occurring near the end of the year will be the amount of the adjusting journal entry. And then net sales is the total sales minus the actual returns to date and the estimated returns. Let's look at an example. During 2024, the first year of operations, Holiday Depot sold merchandise for $1 million cash. That was the total sales. This merchandise cost Holiday Depot $500,000, so they mark up twice their cost is the selling price. Industry experience suggests that about 10% of all sales will be returned. Hence, $100,000 in total of the sales this year will be returned. During the year, customers return $70,000 of the sales. Holiday Depot uses a perpetual inventory system. You'll see what that means in an upcoming discussion. So, if you think about it, about $30,000 of goods are going to be returned early in 2025. That will bring the total from the 70,000 already returned to the 100,000 expected amount, 10% of the total sales last year. So there's the requirements for the case. Record the 2024 sales at Holiday Depot. Prepare the journal entry to record the 70,000 of sales returns that occurred. Prepare the adjusting journal entry at the end of the year to record the estimated additional merchandise sold in 2024 that will be returned in early 2025. And then prepare the journal entry when additional merchandise sold in 2024 is indeed returned early in 2025. Okay, and as always, I would encourage you to quickly work this case and then return, and you'll see my solution, which will be, of course, exactly what you discerned. Good luck. All right, welcome back. So this is the Holiday Depot case, and hopefully you found this pretty easy. Nothing too remarkable there. There's the entries for the sales as they occurred. So I put above it during 2024 merchandise sales because those occurred almost hopefully on a daily basis. And of course, when those sales occurred, we also had to record the delivery of the inventory, the customers taking the inventory. During 2024, when customers returned the merchandise, we debit a sales returns account, which is a contra revenue account and therefore a contra stockholders equity account for the 70,000. And again, the date on these entries, this is various dates as customers return some of their sales, some of their purchases. And at that time, we returned their cash to them. All right, now we come to the end of the year. Oh, and by the way, of course, we have to put those sales returns back into inventory. So we debit inventory and then zero out the cost of goods sold because those goods are no longer sold. All right, now we come to the end of the year and we have to do an adjusting journal entry because recall that our total sales for the year were $1 million. The industry experiences that about 10% is returned in this particular industry. That will vary industry to industry. So we expect about 100,000 of the $1 million of sales to ultimately be returned. 70,000 have occurred, hence 30,000 is our estimate of what will be returned. So that's the amount there. Now let's look at the debits and credits. The debits is sales returns, which is a contra revenue, contra stockholders equity account. But the liability this time is the credit is not cash. When they returned them within the period, we gave the customers their cash by credit, and we credited cash. But here, this hasn't occurred yet. This is what we expect to occur early next year, but we have to account for that expectation. And and the reason for that is that we don't want to overstate sales. So we credit a refund liability for 30,000. That is to accrue a refund liability for expected returns of 2024 merchandise. A total of 100,000 returns are expected. 70,000 have occurred as of the end of the year. So 30,000 more are expected. And when those are, by the way, we also don't want to understate inventory. So we go ahead and we act as if this inventory is back in place. Since we took the sales out, we have to assume the inventory is in. So we have inventory estimated returns, which is an asset account, separate from inventory, of course, because the inventory is not actually here yet, but we expect it to be soon. And then we reduce cost of goods sold, again, that being 50% of the sale price. Our markup is double cost to accrue expected return merchandise. Now, in 2025, eventually it happens. And we first reduce the refund liability because now we're doing it. It's no longer a liability. We're giving them the cash. And of course, this was various days. So I don't have a date up here because it's January 2, January 3, January 4, etc. And then we go ahead and zero out the inventory account for estimated returns because now it's actually inventory. So this is an entry that is a reduction of asset and an increase of an asset, the inventory asset. So total inventory, net inventory didn't change a bit. Okay, little note here, just for your consideration. And I bet you were wondering, I like your curiosity if you were indeed wondering, if actual 2025 returns are not as great as predicted, hopefully that's the case, we will not restate. We just do a catch-up entry in 2025. Okay, so for example, assume that we determine that only 25,000 of the more, so a total of 95,000 of the 2024 sales were actually returned. Well, we go ahead and take out that refund liability, add the sales back in. That'll of course be reported in 2025, but that's okay. And then put the cost of those sales in and zero out those estimated returns at cost. Right. And that's how you treat the estimate, the correction of the estimate when it's slightly off. Right. Thank you for your attention. I hope you found that interesting and have a great day.